Let's stick with a conversation around banks. So now, what are some of the factors that are considered when looking at the performance of those banks and those red flag indicators? Well, with me still is Gary Booysen. He'll help break this down for us. Gary, thanks for staying with us. Of course, banks were a big focal point last week. European banks in particular took a huge knock. So we put a couple of boards together just to talk about some of those red flags. So up on the first one, we've got China as being one of those indicators or a red flag. The second one that we've got up there is emerging markets, which has been said as something we really should be considering. The third one that we have up, I think, was the Eurozone. That is something we should also be considering too. And the fourth and final one is the commodities complex. So we'll try and cram all of those factors in the next couple of minutes, but maybe what are some of your concerns when it comes to the outlook for the banking sector, whether it be global or local?
Yeah, so I mean, you've got to remember all banks are almost GDP players. So depending whether you're looking at European banks, US banks, South African banks, I mean, it's always going to be linked to the GDP. But, I think it's also just the optimism around the sector. So, I mean, obviously, you're mentioning China, you're mentioning the commodities complex. This has put an incredible dampener just on the optimism that the business is going to be good going forward. But if you actually look at our banking sector, I mean, our banking sector, it's incredibly strong. And we've got, they're well-capitalized banks. I mean, we're getting some regulatory changes, but overall, if you don't look at the GDP growth, I mean, it's an industry that's, huge changes coming through from a regulatory point of view, which makes banks more stable, and also the technological aspect of it as well. I mean, you can see that I think it's about 58% of our banks' costs sit in its staff. You've seen staff being shed in the overseas banks, and you're going to see that happening in the South African industry as well. As we embrace technology, as things, more retail banking is done through apps, trading is done through trading algorithms, and that really, I think, is going to compress the cost that the banks have to face. It's an initial IT cost, and we've seen a spike in IT costs at the bank, but at most banks. But as that infrastructure comes in, I think you're going to see a compression of the old costs, and profitability is going to be good. So I think if you're looking at banks in a South African context, there are plenty of red flags. And I mean, banks almost inherently act as a black box. I mean, we saw that in subprime, and what can happen. But from my point of view, I think it's going to be okay.
We always are told that we're not an island, so we are definitely impacted by external factors. The situations that we saw with Europe last week and the likes of Deutsche Bank coming under extreme pressure and their negative interest rates. Of course, we just spoke to Lisiba now, but what's the probability of something like this rippling over or impacting South African banks? I know you said they're well capitalized, but the issues that we're seeing there, is this something that we shouldn't be worried about?
It depends. I wouldn't say you shouldn't be worried about it, but there's a lot of ways that can translate to South Africa. So, when we saw 2008 and the whole subprime crisis, I mean, our banks were more insulated. While we were living in an open economy, I mean, most of our banking exposure is South African. One way that it could translate, and I mean, how we have seen it been translating, is with the US raising interest rates overseas. We've seen the weakening of our currency as we've had to, increase interest rates here. But that currency weakening, I mean, if you look at this in South African banks, they basically have currency risk in two ways. Some of our banks have currency risk, because they actually make dollar-denominated or foreign currency-denominated loans off a South African balance sheet, which doesn't work well for it, or at least puts some risk on it. And the other way is actually to have an offshore footprint. So they actually have branches and that sitting offshore, and then again that currency translation will have an effect on earnings. The thing is, with the weakening rand, it's actually providing a tailwind to most of our banks. So it's actually a good thing. Again, another thing you could look at is, because we now, almost because of the US interest rate hikes, we're being forced to increase interest rates. I mean, we do get an endowment effect. And I mean, we've seen that in the numbers of our banks already. I mean, remember, this is, the last MPC meeting wasn't, even though it was 50 basis points, that wasn't the beginning of our rate hiking cycle. We've already seen improved numbers coming through. I think the one concern that we can have, I don't know if you remember that Moody's report came out about 2 weeks ago saying that our South African banks are not going to get the endowment effect because just of our retail credit profile and how that's going to affect sales volumes. But it's an interesting one. A lot can be said.
A lot can be said. Thank you so much for staying with us and taking us through that. Gary Booysen, Portfolio Manager and Director at Rand Swiss.